Okay, so the question asks, what is the relationship between the federal funds rate falling and the money supply increasing? Okay, so let's think about the general case. So if we think about the market of money, so we have a supply curve and a demand curve. This will be the amount of money available in the market, and this will be the interest rate. And we have a downward sloping demand curve and a vertical supply curve. This is money demand and money supply. Okay. So in the case when the money supply going up, so we will see a right shift of the money supply curve. So this will be the new money supply curve. And we could see that interest rate, this will be the new interest rate I prime, will be lower compared with the original equilibrium interest rate that is I. So basically means that an increase in the money supply will lower the interest rate. Okay, so when the Fed